become a successful DIY investor, you need a plan. And that comes from the answers to 4 questions. Why am I investing? What returns would I like to make? Over what time period am I investing? And what degree of risk am I prepared to take? An investment context, risk is best defined as losing your money permanently. Now, once you've answered those 4 questions, you'll have a feel for your style, trader or investor, the asset classes which may be best for you, stocks, bonds, commodities, property, cash, all have different risk-return profiles and can serve different functions in a portfolio for generating upside or protecting downside, because investment is all about measuring risk with return. So to help you bag some of the upside and avoid the worst of the downside, having a plan and a well-balanced portfolio is a good place to start. But you need 3 more things at least. First is a style. You may be happier being a trader looking for quick-fire gains. Some of you may be happier being an investor, patiently accumulating a savings pot through a mix of capital gains and dividends. One quote to remember here comes from J. Paul Getty, no mug as an investor. I quote, "Stock certificates are deeds of ownership, not betting slips. The professional investor is not impatient, nor is he even in a great hurry, for he is an investor, not a gambler or a speculator." Now, the second thing you need is an edge. This means doing your own research and doing it thoroughly. Tips are for waiters and rubbish dumps. Forget about them. Do your research. Make sure you know why you're buying or selling security, because when you do so, you're effectively telling the market it's wrong, because you're saying the stock, for example, is too cheap or too expensive, when there are umpteen thousand professional fund and hedge fund managers out there all looking at the same stuff. This is a big call to make. You're telling them either they're paying the wrong price on the upside or the downside. I'm not saying you're wrong to make that call. You wouldn't make any money otherwise, but you must have a very good reason for doing so. Again, do your research. It's the most important thing, because you're effectively saying somebody somewhere is paying the wrong price for a security. Now, the third thing you need is a margin of safety. Markets can, do, and will go down. They can be volatile. But if your portfolio is well balanced, volatility, which is basically prices moving up and down a lot very quickly, can actually be an opportunity to buy low or sell high. So that's an opportunity. It's only a threat if you're a seller at the bottom when you lock in a loss, either because you need the cash and are forced to act, you make a mistake and pick a bad one, or you lose your nerve at the wrong time. Now, diversification can help protect you, and so will a focus on the valuation of the assets you're buying. Think about it. You'd never walk into a restaurant and pay 10, 20 or 50 quid for a pizza without thinking about it. You would have a view on whether that meal represented value or not before you walked in, and investing's just the same. You shouldn't pay any price just because there's a good story to be had. If something goes wrong with that story, there's little downside protection. So in sum, you need a plan, the discipline to stick to it. After that, you need a style, an edge, a margin of safety. Then you're ready to go, helped along the way by diligent research and by keeping a keen eye on valuation.